All right. So thank you for making time to join us this evening for Intermediate Accounting 2. My name is Dr. Justin Irogo, and I'll be happy to take you through the course. So, can someone unmute and tell me whether you have all done Intermediate Accounting 1?
Yes.
Okay, good enough. So now, Intermediate Accounting 2, it will entail accounting for liabilities. I'm very sure in Accounting 1, you did accounting for assets. Now, in terms of the accounting for liabilities, we are going to look at current liabilities, and we're also going to look at long-term liabilities. Just a minute, I don't know why my screen is maybe. So now, as I've said, we look at the liabilities in this unit, and we'll start by looking at the definition of a liability. And now, for liability, even from our day-to-day life, sometimes we happen to owe someone maybe some money. You go to your local shop and maybe take some goods on credit. I don't know whether there's somebody who want to join. Just check. If there are people. So if there are people who are on the line who have not joined, maybe class rep, you can coordinate and tell them and let me know whether there are people who are waiting to join, because I can hear some like who want to join. Just checking whether there are people who are on the line who want to join us. Okay. So as I had said earlier, a liability is what we owe other people on day-to-day basis. But in terms of framework definition, we normally say that a liability is a present obligation of an entity arising from past event, the settlement of which is expected to result in an outflow of resources. So this definition, is anyone who want to join? Now, in this definition, everything that you are getting, there is the present obligation, there is the word past event, and there is the word expected outflow of resources. Those are the three key words when you are defining a liability. Present obligation, that refers to the fact that you are obliged to pay presently. Past event, it is something that happened in the past. Ulienda mahali, ukakopa, so you have to pay. So that event happened in the past. But now you are paying it right now. That is where we are saying it is a present obligation. And then we are saying that there is an expectation of an outflow of resources. So you need to pay. In short, you normally say deni ya kukopa ni kulipa. That is what that statement tell us. So now these are the key features of liabilities. Class rep, can you confirm that there are not people who are on the line?
From my end, I can't see.
Okay. So these are the key features that we have talked about. So the first one is the present obligation, that the company has a duty or responsibility to pay now. The past event, something did happen in the past. What happened in the past? It created a liability. You borrowed money or you received good on credit. Future outflow, that means there is a need for you to settle that particular obligation. So there will be an outflow of resources, and these resources are basically money because we no longer have the barter trade. Okay. So classification of liabilities, like the way we have assets. So we have current assets and we have long-term or non-current assets. So now similar to that, for liabilities, we have current liabilities and non-current liabilities. So for current liabilities, these are basically the obligations that the company expect to settle within 1 year. That is 12 months. So in 12 months, for current liability or anything that you can settle within a period of 12 months, that is classified as a current liability. Anything that you settle within a period longer than 1 year, again, that is a long-term liability. So then we have the types of current liabilities. So, we are going to look at some of these in details. So we have the accounts payable, we have the notes payable, we have the current maturity of long-term debts, short-term obligations expected to be refinanced. We have the customer advances and deposit. We have an earned revenue. We have sales tax payable. We have income tax payable, and we have employee-related liabilities. So those are the types of the there are quite a number, but these are the main ones. So let us look at the accounts payable. So this account payable, this is what you owe other. You go to your local shop and take some goods on credit. Yeah, that is basically what we call accounts payable. And what creates account payable? It is the difference in the time when you receive the good and when you make the payment. If, for example, you receive the good today, and make payment tomorrow, that's the time lag that we are discussing. Yeah, so you owe someone by the virtue of the time. So now on the other side, we have the sales term, like you can have 210 or N30, and this state the period of extended credit. For example, if you pay the 210 means if you pay within 10 days, you get a discount of 2%. That's what that figure means. N30, that's not defined. That is, you pay within 30 days, then there'll be no discount. That is what those terms means there. Now, let us look at how we can account for accounts payable. Assume that a firm purchased inventory for Kenya shillings 100,000 to be paid within 30 days. So what will happen? There will be entries that will be passed at the time of purchase, and there will be entries that will be passed at the time of payment. So at the time of purchase, we are required to debit the purchase account or inventory account, and then we are required to credit vendor or the creditor's account, and then when we make the payment, we are required to debit the vendor and credit the cash or bank. Remember, this is the the double entry concept. Increase in asset, we debit. Decrease in asset, we credit. Increase in liabilities, we credit, and decrease in liabilities, we debit. So I'm very sure that concept is still very fresh in our minds. So in this case, you can see that when you purchase goods on credit, you have increased your liabilities. And since the liabilities have increased, we have said increase in liability, you credit. And again, you can see that we have purchased an inventory. So inventory is an asset. So asset have increased. So that means you debit the asset. On this other end, when you make the payment, you are required to reduce the liability. So a decrease in liability, you debit, and again there will be money that will be paid, and again a decrease in uh, asset, you credit. So that is how we pass those particular entry. So in this case, it means we are going to debit purchases with 100,000 and credit vendor with 100,000. And when we make the payment, we debit the vendor with 100 and credit cash or bank with 100,000. Now, I want us to try this concept with what we have just discussed. Let me just lead this question. On April 10, 2025, Alpha Traders purchased good worth 100,000 on credit from better suppliers, and we have the terms. If you pay within 10 days, you get 2% discount. Then otherwise, if you pay uh, with more than 10 days, there'll be no discount. So, okay, meaning a 2% discount within 10 days, otherwise full payment during that days. Alpha Trader paid the supplier on 18th, 2025. So you are required, one, record the initial purchase. Record the initial purchase. I think someone wants to join or something. Oh, yes. So classic, you can text on the WhatsApp. So if there's anyone who want to join, to let us know so that we can be able to trade them in. Now, you want to record the initial purchase in this case. You want to record the initial purchase. So somebody went to the shop, took good worth 100,000 from supplier called Better on Credit. So he took this good on April 10 and paid on April 18. And we are told that if he pays within 10 days, he get a discount of 2%. So in this case, can someone unmute and tell us, will this customer get a discount? You can unmute or you can text.
Yes.
Yes, definitely he'll get a discount. So what will be the first entry? What are we going to record? What are we going to debit and what are we going to credit?
You debit purchases,
Yes.
you credit cash, cash, cash and bank.
No, no that's a good trial. But the initial from the purchase, remember there are two entries here. So we have talked about there is a part of the purchase and there is a part of the payment. So whatever you have said is correct, but that is called cash payment or cash purchase. But here we are talking about a credit purchase where you go take good and pay later, not where you take good and pay immediately. So my question is, when you go to a shop and take a good and you pay later, what entries are you going to record? You're going to debit what? Of course, the first debit is we debit the inventory or the purchased good. So what are we going to credit?
Debtors.
Sorry?
Debtors.
Debtors. So remember, there's something I have said that increase in asset we debit, increase in liabilities we credit. So somebody has gone to the shop, took some good on credit, right? Somebody has gone to the shop, took goods on credit. Now you are assuming that you are an accountant. You're not the one who is selling. If you're the one who is selling, it will be debtors. But it is you who has taken good on credit. So you are going to credit what? When you are recording this in your books, umeenda mahali umechukua some goods on credit. So you have not paid. So what have you created in your books? You have created two things in your book. One, you have created a liability because you are going to pay the person that you do good from. Two, you have created an asset. So your asset has increased. So you're going to debit your asset. That is the inventory. Then you're going to credit the trade payables. So in this case, the trade payable is who? Better suppliers. So you debit inventory, then you credit better suppliers. Are we together? Is that clear?
Yes.
So okay, thank you. So now let us record now the payment. So now here we are told that if he pay within 10 days, he get a 2% discount. So in this case, did he pay within 10 days or not? And let us communicate that you can be able to move faster, and so that we can also be able to understand the concepts. Did he pay within that 10 days or not?
Within.
Within 10 days. So that means he qualifies for the 2% discount. So instead of paying 100, how much is he going to pay?
98.
Yes, it'll be 98.
98.
So 98K. Thank you. So that means in the second one, when we record the payment, we are going to debit the better suppliers, because we have said increase in liability we credit and decrease we debit. So now the payable has decreased because you have paid. So you debit the better suppliers and you credit the cash or bank. So that is how that. That is how we are going to deal with that. So now this is the solution as I had indicated to us. So when you pay, you debit trade payable, you credit cash, and then you credit the discount received. Then you put the narration, being payment to better suppliers with 2% discount. So do you have anyone with a question on that one before we move to the next concept of notes payable? Can you display the answer? Can you see them? Can you see my screen? Maybe, can you see my screen on the solution?
Yes.
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 Yeah, so this is, I have said that you debit the purchase or inventory, 100,000. Then you need to credit the trade payable, which is a supplier, and you have the narration there, being good purchased on credit from better supplier. So if you are told to have a journal entry, if you don't put this narration, then you may not get it right. So it should be as clear as that. So that is the solution for that question. Then, and remember this is for the initial purchase. Then when you are told now to, when you are told to record the payment. So this payment is with a discount. So the first thing you need to do is for you to calculate the discount. So the amount that you owe is 100,000, but you are told that if you pay within 10 days, you get a 2% discount. So you need to calculate the discount. So which is 2% times 100,000, which gives you 2,000. Then that means the amount that you are going to pay, it is 100,000 minus 2,000, which is 98,000. Yeah. So and when you are recording the entry here, you come and debit trade payable 100,000. You credit, you then you credit to bank or cash. It has reduced to with 98,000, and then the difference will be the discount received of 2,000. So that is how you record that transaction or entry. A question? Are we following up, or I'm losing you?
We are together.
Okay. So now let us look at the notes payable. So now for the notes payable, these are a written promise to pay a certain sum of money on a specified future date. And this it arises from purchases, financing, or other transactions, and notes classified as short-term or long-term. Note may be interest bearing, or it may be zero interest bearing. So if it is interest bearing, it is normally indicated on the face value. So these notes payable, they are actually given by corporates. Corporates are the one who are known for the notes payable. It's more similar like IOU note, where you can go and take goods and then you give somebody a note indicating that you owe them some money. And now these notes payable, sometimes they may have some interest on them, or sometimes they may not have interest. And if they have interest on them, the interest is normally indicated at the face of the note that you are given. Example, this one is interest bearing note. National Bank agrees to lend shillings 100,000 on March 1, 2010 to BC company. If BC signs a six, if BC signs 100,000 6% 4-month note, required journal entry to record the cash received. So we have the BC who we are given 100,000 notes, or they are given 100,000 by National Bank, and this is the note payable. Now, in this case, when they receive the money, and I want us to always remember this concept. When you are thinking about in a journal, can you think, can you classify, is this an asset or liability? That is the first starting point. If it's an asset, just know you're going to debit because the asset has increased. If it's a liability, you credit. That concept should always be the guiding principle in accounting. Actually, it's the double entry rule. So in this case, the BC have received some money from National Bank, so they are going to debit cash, and then they are going to credit the notes payable. That is the initial transaction, that is the initial entry that they are going to have in their books. Yeah, that is the first entry that we are going to have in our books. But now remember, there is this concept of 6% 4-month note. 6% 4-month note. So you need to calculate the interest that will be paid, because this note, it is interest bearing. So in this case, you need to calculate the interest. So the amount that was given was 100,000. The interest is 6% per annum, but it's a 4-month note. So you prorate the interest for the 12 months to 4 months. So you need to get what is the interest payable within 4 months, and that is 2,000. And now to record this, you debit interest expense and you credit the interest payable. Interest expense, this is an expense. Again, from the P&L side or from the profit and loss account, we normally say when an expense increase, you debit. When an expense decrease, you credit. Now, when they are making the payments, when they make the payments, again, they are going to record these entries. First one, they record the notes payable, which is 100,000. Then they debit interest payable, which is 2,000, and then they credit cash, and the cash will be a combination of note payable and interest payable, which is 102. And the reason why it is 102 is because this note, it is interest bearing. So we have added 2,000 on top of the amount that was given. Is that clear? Or is anyone with a question before we move to the next concept? So we have zero interest bearing. On March 1, BC issues 102 4-month zero interest bearing note to Castle National Bank. The present value of the note is 100,000. So how is BC going to record this? First, BC will record what they received. So BC received 100,000. Then the note was for 102. So therefore, here is a discount on the note, and then we are going to credit the notes payable. So that is how we are going to record that transaction. And remember again, always carry the same concept: increase in cash, increase in asset, increase in liability, increase in notes payable. How are you going to treat this? So that the double entry should always be your guiding principle. So we have a class activity here, which I want us to try and post the answer. So I'm going to give you some few minutes. You try that question and post the answer on the double entry. Can you try that one? So I'm going to give you 5 minutes. So right now it is 8:20 p.m. So by 8:25, let's see if you can be able to crack something on that one. Is there anyone who has been able to crack something? Can you read it together? Yes. Am I audible? Let me know if you can hear me.
Yes, we can hear you.
Okay. Imeturemea. We do it together. So XYZ Limited issue a 1-year note payable of Kenya shillings 100,000 to ABC Bank with no stated interest due on December 31st, 2025. The fair value of the cash received is Kenya shillings 90,000, and the difference represent implied discount or stroke interest. So required initial recognition on January 1, 2025. 2. Year-end settlement on December 31st, 2025. What I have said is that if you are given this kind of a question, ask yourself, what is it being created here? So this money which is being received, the first thing, it is money which is being received, just debit cash or bank with 100,000. But now in this case, he received 90,000. Yeah. So we have the money which is being received of 90,000. So you need to debit the cash or bank 90,000. Then the note payable is 100,000. So there is a discount on note payable of 10,000. Then you credit the whole amount of 100,000. That is how we are supposed to go about it. Then the second part is now at the end of the year. So at the end of the year, we are going to have, okay, this is a more detailed journal, but at the end of the year, what we need to do is to debit the interest expense, 100,000, then credit the discount on note payable, then debit note payable because it is reducing, then credit the cash. Again, that is how we are supposed to conclude on that question. A question? Mtu ako na swali? So let us keep engaging so that at least we are able to understand how things are moving. So here we have another class activity. XYZ Limited also issued 1-year note payable of Kenya shillings 200,000 to DEF Bank with 10% stated annual interest payable at maturity. Required, prepare the journal entries for 1. Initial recognition on 1st January 2025, and 2. You do year-end settlement on December 31st. So on initial recognition, as I have said, what you need to do is think about what is being created. Number 1, there's money which is being received, and there is a note payable, which is there is a note payable. There's somebody who want to join. Who is this? So the money which is going to be received is 200,000, and the note payable of 200,000. So that is the first transaction. Very simple. The two things that will be created. Then on payment, there will be a 6% interest. Yeah. So get the interest expense, which is 20,000, credit the interest payable, 20,000, debit the note payable because you have extinguished, you have paid, then you credit the cash that has moved out. So, and I want to really emphasize that for you to get it right, think about what is being created. If there's money which is moving out, just credit. If there's money which is coming in, just debit. If there is a note payable which you have gotten, credit. If there is a note payable which you have paid, debit. Because increase in asset, you debit, increase in liabilities, you credit, and vice versa. So now the other concept is on customer advances. So now customer advances is whereby if you are, for example, employed as an accountant in a company, and it happened that customer pays you and they have not carried the good. That means you have the money, yeah, and you can't recognize that money as revenue because you have not delivered the good. Until you deliver the good, that's when you can be able to recognize that money as your sales. But when a customer makes payment and they have not carried the good, that is a liability in your business. So customer advances are amount received in advance from customer before goods are delivered or services are rendered. And this may be classified as current or long term as the company owes the goods, service, or refund. So when you receive customer advance, you owe the customer either the money because the customer may ask for a refund, or the service, or the goods. An example, on January 1, 2025, a customer pays Kenya shillings 50,000 in advance for an order to be delivered in February. So here you are required, 1, journal entry on receipt of advance, and 2, journal entry on delivery of good or service. Again here, the way I have said, you have received 50,000, just debit cash or bank. And then this money came from who? Customer. So you can credit customer advance. Simple. Yeah. But when you deliver the good, um, again, what you need to know is that the money is sitting on customer advance. It's a credit. So debit customer advances, then you credit the sales because increase in sale, again, you need to credit. And now this is a solution here. Debit bank or cash, 50,000. Credit customer advance, that is an earned revenue, 50,000. Then when the goods are delivered, you need to debit cash or customer advance, then you credit the revenue. So now there's another question here on the same. ABC Limited received Kenya shillings 120 from a customer on March 1, 2025 as an advance payment for goods to be delivered on April 15. The company delivered the good on the agreed date. So required, 1, the receipt of the customer advance. So we have said when the customer pays an advance, you need to debit the money that you have received, debit the cash with 120. Then you credit the customer advance with the same amount. When you deliver the good, debit the customer advance, and then you credit the sales. Yeah. Explain how the customer advance would be reported in the financial statement on March 31st, 2025 if the good had not yet been delivered by that date. So if the good has not been yet delivered, so the customer advance will be recorded as liabilities. And this is the summary here. Balance sheet, these are the current liabilities, then customer advance, because customer advances are liability as we have said. So that marks the end of lesson 1 for week 1. So I have tried as much as possible to simplify the concept so that at least we can have a fresh start. But I'm very sure as we continue interacting, we'll be able to familiarize ourselves with this and more. So I'll be sharing this note with us as well as the recording for your review. So we can meet on Tuesday, on Monday next week, unless there's anyone with a question. Kuna mtu ako na swali? Are we good?
Yeah. Yes.
Yes,
Okay,
we are fine.
you're fine. Eh? So just make sure you revise. Don't wait for this work to pile because accounting is very interesting. If you pile the work, you find that at the end of the day maybe you may end up forgetting. So make sure you you keep on revising when the concepts are fresh so that you can make the best out of it. Otherwise, I wish you a good evening.
Thank you, you too.
All right.